Welcome back to The Explainer. Man, I am so excited to jump into this one today. We're going to take a fascinating, high-performing medical technology giant, Stryker Corporation, ticker symbol SYK, and we are putting it through an absolute gauntlet of evaluation test. We're talking the legendary investing frameworks of Warren Buffett, Peter Lynch, and Benjamin Graham, and then we're going to stack those up against modern discounted cash flow models and Wall Street's glowing consensus. So is Stryker a medical miracle for your portfolio, or is it just kind of priced for perfection? Well, let's find out together.
All right, here's our roadmap for today. We're going to kick things off with a quick snapshot of Stryker, then sequentially pass it through the Buffett, Lynch, and Graham lenses, build out a modern DCF model, and finally, synthesize it all into a final verdict. Let's just jump right in.
Section 1. The company's snapshot. Okay, let's dive into exactly how Stryker is performing right now, pulling straight from their Q1 2026 SEC filings.
You know, the sheer scale and stability of this underlying business is honestly pretty striking. Trading right around $327 a share, Stryker pulled in over $6 billion in first-quarter sales. That's a rock-steady 2.6% increase, mostly driven by organic volume growth in their med-surg and orthopedics divisions. They reported an adjusted EPS of $2.60 for the quarter, and get this, they're sitting on a massive $22.9 billion in shareholders' equity. So by all accounts, the core business engine here is just humming along beautifully. But as any seasoned analyst knows, a great company isn't always a great stock, right?
Which brings us to Section 2, the Warren Buffett lens. Basically, what would the Oracle of Omaha do here?
Now, before we get too deep, let's just quickly define a crucial concept so we're all perfectly on the same page. Owner earnings. It's essentially free cash flow. It's the actual, tangible cash a business generates from its operations, minus the capital expenditures required to just maintain that business. Basically, it's the true cash left over for the owners, us, the shareholders.
So Buffett looks for a few very specific things, right? He wants an impenetrable economic moat, consistent earnings, and manageable debt. And honestly, Stryker passes those first two with flying colors. Their economic moat is incredibly strong. I mean, they're a global leader in med-surg and orthopedic tech, which naturally comes with high switching costs and massive regulatory barriers to entry. And earnings? Super consistent, bringing in $1.0 billion in adjusted net earnings just this past quarter alone. But that third metric is a bit of a speed bump. Stryker is carrying a pretty hefty $14.2 billion in long-term debt compared to just $2.8 billion in cash. Since Buffett generally prefers companies that can pay off their debt within a few years of earnings, this kind of leverage is a distinct negative in his framework.
But what about the actual price? Well, according to Guru Focus data, Stryker's free cash flow per share, which is our proxy for owner earnings here, is $11.83. If we apply a standard, sensible 15 times multiple to those cash flows, Buffett's target intrinsic value would sit somewhere near $177 a share. And that leaves us with a glaring problem. At the current price of around $327, there's absolutely zero margin of safety for a classic value investor. So Buffett would likely admire the business, for sure, but he'd probably just sit patiently on the sidelines, waiting for a massive discount.
Moving on to Section 3, the Peter Lynch lens. Let's see how the legendary Peter Lynch would categorize and evaluate a stock like this.
Under Lynch's famous categorizations, Stryker is a classic stalwart. It's a massive, multi-billion-dollar company that, isn't going to triple in size overnight, but it does offer reliable, steady growth, especially during economic downturns, and that's a huge pro. But Lynch is also famous for pointing out that while insiders might sell stock for a million different reasons, they usually only buy for one. They think the price is going up. And well, that brings us to the executive suite. Over the last 6 months, a major warning sign has popped up. Insiders have sold Stryker stock 35 times. Purchases? Literally zero. Director Rhonda Stryker alone unloaded over 1 million shares. We're talking about $366 million worth of stock just dumped by insiders. And this brilliantly illustrates a core Lynch rule. You always follow the insider money. A mass exodus of stock from the people who know the company the absolute best? Yeah, that's a blaring siren we just can't ignore.
Furthermore, Lynch relies heavily on the PEG ratio, right? Price to earnings divided by the growth rate. He ideally wants to see a PEG of 1.0 or lower, while Stryker is currently trading at roughly a 32 PE multiple, and based on their guidance, they're growing organic sales at maybe 8 to 9.5%. So if we take a generous 9% growth rate on a 32 PE, we get a massive PEG ratio of 3.6. Because this is so far above Lynch's ideal 1.0 threshold, and you combine that with the heavy insider selling we just talked about, the Peter Lynch lens triggers a definitive avoid or sell.
All right, let's move to Section 4, Ben Graham's intrinsic value test.
We're going to apply the father of value investing's famously strict intrinsic value formula to this thing.
As you probably know, Graham insists on a notoriously rigorous defensive investor checklist. Adequate size? Pass. They've got well over $46 billion in total assets. Earning stability? Pass. They're highly profitable. Dividend record? Another pass. They paid out $337 million in Q1 alone. But then, we hit the roadblocks. Strong finances? Fail. Graham wants current assets to be at least twice current liabilities and long-term debt to be less than net current assets. Stryker's $14.2 billion debt pile totally fails this conservative test. Moderate valuation? Fail again. Graham generally caps his PE limit at 15. Stryker is sitting way up over 30.
Let's actually do the exact math using Graham's famous intrinsic value formula, the square root of 22.5 times earnings per share times book value per share. First, we take their $22.9 billion in equity and divide it by their 386.5 million diluted shares. That gives us a book value per share of $59.45. Next, we take their Q1 adjusted EPS of $2.60 and multiply that by 4 to annualize it, which gives us $10.40. Finally, we multiply 22.5 by $10.40 by $59.45 and then take the square root of the whole shebang.
And the formula spits out a rather brutal intrinsic value of exactly $118. I mean, that is roughly 1/3 of where the stock is trading today. For a true Benjamin Graham defensive investor, buying Stryker right now offers absolutely zero margin of safety. It really is a wonderful business, but the price is simply mathematically unjustified under classical value rules.
Okay, Section 5, DCF and Alternative Models. Let's pivot from classical philosophy over to modern financial modeling.
So if we contrast Graham's incredibly stingy valuation with the analyst targets over at Benzinga, it's kind of wild. Modern Wall Street analysts are exceptionally optimistic about Stryker's momentum right now. Across 23 analysts, the lowest price target is $330, which, by the way, is still higher than today's actual price. The average target is an impressive $406.77, and the most bullish see it running all the way up to $465. But keep in mind, this is largely driven by forward-looking PE and EV to EBITDA multiple expansions rather than strict intrinsic asset values.
Let's actually build our own forward-looking discounted cash flow model to try and bridge this gap. We're going to start with that $11.83 in free cash flow we found earlier. To complete the model, we'll assume a standard 8% weighted average cost of capital, or WACC, and a 2% perpetual terminal growth rate. These are really standard, appropriate assumptions for a mature healthcare stalwart like this. But here's the kicker. Even if we lower the discount rate to 7% and bump up terminal growth to 2.5%, the absolute highest intrinsic value we can generate in this model is $270.
Looking at our core base case assumptions, our DCF lands exactly at a fair value of $200 per share. Meanwhile, Wall Street is targeting $406.77. So what does this tell us? It tells us that modern analysts are either pricing in a massive, totally unprecedented explosion in future cash flow growth that defies all historical averages, or they're relying entirely on comparable multiples. They're just betting that investors will simply continue to pay 30 to 40 times earnings forever just because the MedTech sector happens to be hot. Which brings us to Section 6, the synthesis and final verdict. So, the crucial point is, how do we make sense of this massive disparity? Looking at the final scoreboard across all our frameworks, it's pretty eye-opening. Under Buffett, targeting owner earnings, the buy price is $177. Under Peter Lynch, the high peg and heavy insider selling flash a strong avoid signal. Under Ben Graham's super strict asset and earnings formula, the intrinsic value is a mere $118. And our modern DCF model places fair value around $200. Yet Wall Street screams buy with a target of nearly $407. The synthesis here is pretty clear, right? Stryker is a fantastic, highly profitable, brilliantly managed underlying business. But as an investment at $327, it fails the classic value gauntlet across the board. The risk-to-reward ratio here is basically entirely reliant on market momentum rather than underlying fundamental cash flow metrics.
It really brings us back to this fundamental truth from Warren Buffett. Price is what you pay. Value is what you get. Wall Street sees unstoppable momentum and massive institutional demand for reliable healthcare stocks, which is exactly why they justify paying 32 times earnings. But the legendary value frameworks, they demand a much lower buy price to actually trigger a margin of safety. Those frameworks exist to protect you from downside risk when the music inevitably stops.
So I'll leave you with this final thought today.
Look at that massive gap between the $200 DCF value and Wall Street's $406 target. Is that a sign of unshakable MedTech momentum that value models simply can't capture? Or is it a very dangerous departure from intrinsic value? If you're a momentum trader, hey, maybe you just ride the wave. But if you're a focused learner trying to build wealth safely, the frameworks tell you to admire Stryker from afar and patiently wait for a correction. Thank you so much for joining me in this explainer. I hope this structure really helped clarify what is a very complex stock. Keep learning, keep analyzing, and I'll catch you in the next one.